welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. We're coming to you live from Miami at Exchange in ETF Experience, and we're meeting with the top thought leaders and innovators in the ETF space. Joining us for this segment, we have Tom Lydon, CEO of ETF Trends, to discuss the key trends that we are hearing at Exchange this year. Tom, it is so great to be back on the ground with everyone.
So much for being here, Jill.
It's
good to see you.
It feels like a big high school reunion, and it's so great to see even the new entrants that we see within the ETF space right now. But I want to talk about first quarter ETF flows. We saw a lot of volatility in the first quarter of the year.
We did, yeah. It started out quite positive. We saw equities continue to do quite well. However, more of the same in the fixed income side, where it had been quite challenged based on the threat of rising interest rates and inflation. Not a lot of flows, where 2 years ago, we actually saw more flows in the fixed income area of the marketplace than we saw in equities. So the crazy thing to think about is US equity fixed income flows are actually less in the first quarter than commodity flows. Makes sense based on threat of inflation. See the CPI print that came out today. It doesn't seem like it's going away anytime soon.
And you know, it's so interesting, Tom, one of the hot topics that we've had on the show so far today has been active management, particularly in the area of fixed income, because not all fixed income is the same.
Right. No, you're absolutely right. When you think about our benchmark is the ag, and the ag is chock full of treasuries and mortgage-backed securities that are somewhat toxic in a rising rate environment. So advisors, and all the advisors we're talking to today, have actually deconstructed the ag for their clients, so they're moving away from more mortgage-backed securities, they're moving away from treasuries, they're going into short duration corporates or high yields, a lot in money market funds, and then frankly, cash or alternative strategies like options overlay income strategies, or even moving some over into preferreds that do well in a rising rate environment, or dividend strategies.
Yeah. What are some of the key trends that you're hearing in Exchange?
So a couple things that I think we're touching on. Advisors are less concerned about equity volatility. They're actually buying on the dip. It's crazy. We're seeing more money go into the S&P 500 type ETFs. VOO, the Vanguard S&P 500, has over $30 billion in new flows in the first quarter. Unbelievable. It was interesting because in the first quarter, the first month, in January, we saw international funds actually have a bit of an uptick and also value. However, when the Ukrainian crisis hit, all bets were off. People are now, from an equity standpoint, have more of a home country bias, and that's really key and critical. But the key is advisors are more concerned about fixed income. So they're, as we said, moving away from the ag, but also moving away from fixed income altogether in many cases, and putting more money on the equity side or alternative side.
Right. And you know what I like about the conference this year? It's not all panels and fireside chats. They feel much more intimate, more one-on-one type conversations. I've noticed that the audience has been able to engage with the speakers more. Yeah. What have been some of the more well-attended conversations that you've seen this morning?
Jeff Gundlach was awesome.
Yeah, so good quotes came out of there.
I mean, it was great. Not only is he such a smart guy, he's so dynamic in so many ways, but you know, the Fed, for example, in the last couple of years has been signaling, don't worry about inflation, we got it handled. Now they're a little bit more worried. The crazy thing is we're surveying advisors all the time. 2 years ago, that was their biggest concern. He came out today and said, this is not going away, and advisors in the audience agree.
Yeah.
So until the Fed gets on board and acts, and that's not going to be easy. It's going to be a Band-Aid that's going to hurt when it gets ripped off, but it's going to have to happen.
Yeah, didn't Gundlach say something to the effect of the only thing that was transitory was using the word transitory? I saw that on Twitter, and I thought that was brilliant. And I guess a lot of the advisors are thinking to themselves, okay, you can raise interest rates, but there's so much going on underneath the surface, whether you know, you're looking at geopolitics, and if you're looking at unraveling this monetary policy, it seems as if we could be in this kind of environment for a while. I mean, that print this morning was pretty astounding.
It's scary. It's scary because people were thinking it was going to head in the other direction, and we haven't. Listen, last time we saw this was in the late 70s, and advisors here either weren't born, weren't managing money, and if they were, they're ancient and probably out of the business. So many of the advisors in today's marketplace haven't gone through a period of time where it's been an extended period of inflation and what that means. And it's painful. You have to really act to it. And Many people feel that the money that's gone into commodity ETFs, it's at the top right now, so if you're buying, that's it. We could see this for another 3 or 4 years.
What I think is interesting on the topic of advisors is the technology that's available to them now. We had Flex Networks on just about an hour ago, and all the different touch points that are available on one platform for advisors, which is a great thing. Like to your point, if you've never been through this before, you're going to need a lot of help and advice for yourself.
Absolutely. Well, with ETF Trends and ETF Database, we're putting about 50 to 60 pieces up a day. We also have tons of data, and we take that data from a behavioral standpoint, and advisors, by their eyeballs, tell us what they're most interested in. So if it happens to be inflation, happens to be rising interest rates, we'll dig deeper to give them more of what they want, and they act with their feet. If they're looking at it, great. If they move over to something else, we do that as well. And we share that information with the ETF issuer community because sometimes they're slow to move, and the markets, as you know, you're covering it every day.
Right.
It moves so quickly, we have to keep up to speed with all this.
All right, Tom, great to see you again. Thanks
Great
for joining us on
seeing you,
Trade
Jill.
Talks. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.